Should you lock in a 5% rate of return? Keep watching to find out. This has been a popular question that we've gotten in the back half of 2023 here. Should I allocate more of my investments or move all of my investments to cash or fixed income now that I can actually earn something on it? It's true that money market funds, treasury bills, some fixed income products, and even online savings accounts are offering north of 4% and probably closer to 5%, which is a welcome change from earning basically nothing on those types of investments for the last decade. But to move your investments or to make investment decisions based on that is a drastic change. So let's break it down. It's been recently reported that millennials, of all people, have more of their investment accounts allocated towards fixed income and cash. They have more than even their older generations, the Gen Xers and the baby boomers. So Schwab did a study that found that the average millennial allocation to fixed income is 45%, basically 50-50 stock bond or stock fixed income split. And that number is 37% for Gen Xers and 31% for baby boomers. This is backwards from common investing wisdom. Usually the younger you are, the more you have allocated to stocks and the equity side. The older you are, the more you're allocated to fixed income. So maybe it has something to do with the tough market environment over the last 2 years, or maybe people are becoming aware that they can actually earn something on their cash. But generally speaking, and not giving specific investment advice here, but generally speaking, millennials are in their prime working years. They're in their late 20s to early 40s, which means if this is retirement money, you still have another 30, maybe 40 years to go until you need this money. So to lock in some rate of return via fixed income or cash is not a wise decision, in my opinion. Ben Carlson wrote about how investing in the stock market is the opposite of playing the casino. The casino, the longer you're there, the likelier you are to lose money. In the stock market, the longer you play in the stock market, the better your odds of success. Over a daily time horizon, your odds of success in the stock market are 56%. Over a year, it's 3 out of 4. Your odds of a positive investing outcome in the stock market is 75%. Over 5 years, that number goes to 88%. Over 20 years, that number is 100% chance of having a positive investing outcome in the stock market. 100% chance. So that goes to show, if you're a millennial in your 30s and you're averaging in to fixed income, you might be doing something wrong. Again, that's the stock market, not the bond market or cash. The stock market has outperformed both fixed income and cash over longer time horizons. Also, if you're still in your accumulation phase of your investing journey, meaning you're still adding to your investment accounts, not taking out of your investment accounts, you want to be sending money in at lower prices, because at lower prices you're buying shares of whatever you're investing in at lower prices, which speaks to the whole buy low, sell high thing, which is what this is really all about. Cash can be a great place for short-term needs. If you need the money in the next 1 to 3 years, that money should be in cash, should be not invested in the stock market, because you need it. You don't want it to fluctuate too much. But for longer term money, you should think about allocating more towards the actual stock side of your portfolio. You don't want to confuse short-term and long-term dollars. So if you need help getting your allocation straight, get in touch with us. Everyone's situation is different. So if you need help, get in touch with us. That is going to do it for this week's episode. Thanks as always for tuning in.